All right, and welcome back to The Real with Rachel, where I'm Rachel Smith, RE/MAX Realtor, and again, very edited, coming to you from NFM Studio with Jeremy Pauling.
Thank you for having me.
Thank you for having me.
Absolutely.
Thanks.
All right.
We're having each other.
Real with Rachel.
I mean, hey. Let's talk about the Federal Reserve.
Oh, boy.
And the meetings that are happening the 17th and the 18th, with an announcement on the 18th. And what are we expecting Mr. Powell to announce on that day, sir?
So, end of the year, right? 2024 blew by, right? And it had some ups and it had some downs. And I will tell you, this was probably
ups and downs.
One of the more turbulent markets that we've seen for quite some time.
I'm so excited for 2025.
Are you?
Oh, yes.
Yeah. Well,
and 6.
Well, 2024 may go out with a bang, right? Fed Waller did explain that he is now potentially in favor of additional rate cuts at the December 18th meeting.
Yeah. So is that what we're expecting, realistically? And what are we expecting? What are we hoping, right? Because they're two different things. Okay. And even though we all are hoping for rate cuts, realistically, behind the scenes, that's not necessarily a positive indicator of a good economy. So Let's talk about that.
That is correct, right? I mean, well, the world that we live in is a very small place now, right? You have social media, headline coverage, right? You know, all of these platforms that, you know, move information in nanoseconds, right?
Correct.
So you have some volatility, right? You have things going on in the Middle East right now. You have, you know, South Korea today, you know, potentially issuing martial law. You still have conflicts in Russia and Ukraine. And you have a new president, you know, coming into office, you know, mid-January, right, here in the United States. So there's a lot going on, right? The markets normally follow the verbiage, you know, of the minutes that are released after each of these meetings to really get a true indicator as to what that's going to look like. And I think right now, I think everybody can agree, right? Even though we had huge rate cuts in September.
Yeah, we were not expecting. I think a quarter and ended up being a half.
They weren't expecting that. Rates actually have gone up since then, right? So it wasn't necessarily tied to the overnight interest rate cut that the Fed has chartered, but more so they're looking at the numbers within the economy. Now, the one thing I will tell you is, right, it's end of the year, you have holiday spending, right? And
I was just thinking the same thing. And with job reports, everybody's hiring for holidays, so those reports aren't going to be accurate. I get so frustrated.
Right. Jobs, right? You have the jobs report with, you know, the seasonal hires, right? You have holiday spending on the consumer side, right? Combine that with the fact that there have been some skewed jobs reports coming out of, you know, some of these, you know, analysts recently. You know, you do have the potential that, you know, you may coast into 2025 on a very positive note, and that may give you a little bit of easement, but the true telltale signs are going to really, I believe, take place, you know, in the first 100 days of, you know, our new president's
correct, 2025.
Yep.
Yeah, because I think now it's more just a fluff ball of information that's just not, I feel like the accuracy of it isn't accurate. And I think it's so hard to tell, especially on an election year, at the end of the year, where we're at with the market, with the rates, and with the inventory. It's almost like this, I feel like it's almost like a bomb. So what's going to happen in 2025? Something's a landslide, right? Something's going to have to move here. So as far as what we're hoping, if we were hoping for rate cuts, maybe to what degree would that be? What would you say would be the sweet spot for a rate cut right now without signaling red flags?
So keep in mind, right, the biggest thing that you're looking at is, you know, these rate cuts. That's the overnight exchange rate that these banks are cutting, right? That's not directly a mortgage-backed security or a mortgage rate that they're cutting.
It's
so
just
there's layers to get to that, right? Also, again, everything is speculation right now until you actually have the new president in office. And he starts, you know, his signing of executive orders, and the House and Senate get back to work, you know, in 2025. Again, you can only rely on the market data that's out there. Again, we just talked about it, right?
Everything's looking fancy and fabulous.
Right, consumer spending, right? Consumer spending, you have...
So why would we cut the rates?
You have a lot of it, right? You have consumer spending, you have seasonal hires, right? So the jobs reports are going to be a little bit skewed. You have the Fed putting information out there that they support, another rate cut just based upon the inflationary, news and data that they have. So, like I said, I mean, you're going to coast into 2025, I believe, pretty smoothly. I think that, late January, early February, it's going to set the trend for how 2025
start
goes.
hearing some of this, some of
Absolutely.
this. Now, we all know how rates affect buyers. How do the rates affect sellers?
Well, I mean, think about it this way, right? If a seller knows that there are, 4 potential really good qualified candidates to buy that home, in today's, market, right? And if there is a slight adjustment to interest rates, and, when I say slight, I'm talking even 1/4% or 0.5%, that may increase that buyer's pool by 10 other buyers.
Yep.
Right.
Yep.
Somebody's going to be a little bit more eager to sell a property if they know that they can
If
command
they have a bigger buyer pool, which in
Yeah.
turn could
course.
warrant a higher price, even
Correct.
potentially some bidding wars. So that's how it would affect sellers.
It takes them off the shelf, absolutely, 100%. It definitely will intrigue a lot of individuals to jump back into this market if they know that they're getting a deal, right? And what does a deal look like? Nobody really can say that we're not getting a deal. I mean, interest rates are still historically very affordable,
Yeah.
right?
But remember, we got Matt slapped
Yes.
in the COVID with the
Yes.
good juice.
Yes.
And so
Yes, 100%. Yes.
And so now everybody that's been, a potential candidate for buying a house is now like, wait a second, it used to be 2 and 3%. I'm not going to be. And it's like, dude, this is still, the problem is that the housing prices are still somewhat reflecting what were happening back with
Yes.
those lower rates.
Yes.
And so kind of trying to balance that out, which again, I don't know if the housing prices are going to be dropping drastically because everything down to bubble gum goes back to supply and demand.
Yeah. Well,
Right?
I mean, you can have that conversation all day, right? I mean, we talked about it last time we met.
We talk about it all the
Geographically,
time.
where we are in the greater metropolitan Washington D.C. area, we're insulated a lot from that. I mean, they did
Yeah.
release numbers. I think year over year so far. Freddie Mac came out today, and it's 3.7% average across the nation. So even in a higher rate market where some of these rates even peaked 8% this year, you're still almost 4% year over year in some of the coldest months of the year.
Good facts.
Yeah.
All right, so to round it out for 2025, what are we expecting? Are we expecting a little rapid fire rate cut there? Or are we going to have it prolonged? Or are we just going to be coasting? What is your prediction?
I mean, I tell you, speculation's tough, right? But I will say,
Crystal ball.
some of these economists are thinking that, as the population continues to grow, right, home shortages are still going to become an issue, right? Inventory, as you know, on your side, is a real problem. You get even into a rate environment to where you're maybe 0.5% or 0.75% lower than where we sit today, you will have a frenzy of buyers. You will have a frenzy of new homeowners coming to the market, right? Because rents right now, I mean, again, it's hard to predict what that'll look like in 2025, but rents are starting to become unaffordable for most families.
Correct. Yeah, it's
Yeah.
it's getting
Yeah.
a little drastic here.
Yeah.
All right, tax season is coming up in 2025. What do you want people to know? What are we displaying to others to say, hey, tax season's coming. This is what you need to do to prep if you're going to be buying or anything else?
So, first and foremost, find yourself an incredible, right, CPA or tax preparer, right, licensed tax preparer to help you, because tax code nowadays is very confusing, right? And prepare yourself. Have your mortgage statements, have your mortgage interest statements, have any settlement statements if you have gone to closing in the past 12 months. Make sure you have that in hand. As you start to see some of these new tax bills being passed or potentially being passed, that'll be an ever-changing market, and that's why it's always important. Spend that extra few $100s, have a licensed tax preparer in place for you, because I've even noticed, even recently, I mean, we're starting to get slammed. People want to close by the end of the year to take advantage of those, those tax benefits. So let the professionals really help you to sort that out.
I think that, and then also, if you have questions about, hey, filing taxes, especially if you're an independent contractor, maybe bounce the idea off your mortgage professional and your CPA at the same time, just to make sure that you guys are being aligned in the right way to qualify, because sometimes it's a little bit different when you're in your own business.
It's a double-edged sword, right? I mean, obviously, if you're operating inside of, legal tax code, I mean, these deductions are legal, right? But also remember what you put on paper, IRS is going to see, right? And that's what you're going to pay tax on. What you pay on paper, your mortgage lender is going to see, and that's what you're going to qualify on. So it's a double-edged sword, for sure.
So, big news with the new conforming loan limits.
Yes.
Yes. What are they, and how are they so fabulous?
So I believe it was a crazy increase this year, right? You went from the 766 500, you're all the way over 806 now. So I mean, that's a pretty big jump.
Which is good for this territory.
I mean, all across the nation, right? I mean, I have some clients right now down in the state of Florida, and they're trying to get to that conforming number just because the difference between the non-qualified mortgage or the non-QM market or jumbo loans as you know them and the conventional market, you're probably talking a whole 0.5% in interest rate.
Exactly. So essentially it's saying, hey, less riskier loan to the investor to package up. So it's going to be a little bit more attainable per se.
It's a qualifying factor. Yep, conventional loan. So it's a big deal.
Well, once again, it is always so much fun getting to chat with you on The Real with Rachel. And thank you guys so much for watching, and stay tuned for the next one.
Thanks, guys.
Bye.